यहाँ rewritten script है, एक continuous flow में, कोई अलग paragraphs नहीं. Something has quietly shifted over the last 2 years. No major headlines, no congressional debate, no public announcement. The rules surrounding the $10,000 bank reporting law have been updated 5 times since 2024, and each of those updates has made it more complicated and, in some cases, more costly for ordinary Americans to manage their own money. This is not about something that might happen in the future. These changes are already in effect. They're being applied in bank branches across all 50 states right now, and most people over the age of 60 have not been informed about any of them. I'm going to walk you through 5 specific changes that have been rolled out between 2024 and 2026. Change number 1 gives banks the authority to delay your withdrawal for up to 72 hours, even if you have banked there for decades and your reason is completely legitimate. Change number 2 means that a pattern of deposits just under $10,000 can trigger a federal investigation, even if every dollar is clean. The detection software that identifies these patterns was upgraded in 2024 and now flags behavior it previously ignored. Change number 3 brings crypto transactions, Zelle transfers, Venmo payments, and Cash App sends into the same federal reporting system that was originally designed to track large cash movements. The reporting threshold on those digital payments is dropping to $600 this year. Change number 4 significantly raised the penalties on a form that your contractor, attorney, car dealer, and many other businesses are now required to file about you. And change number 5 is not a new rule at all. It is a number that has not moved since 1970. And that frozen number is the reason all 4 of the other changes are affecting ordinary retirees. My name is Marcus Graves. I am an enrolled agent with over 20 years of experience representing taxpayers before the Internal Revenue Service. What I want to share with you today is practical financial awareness. Because the $10,000 bank rule that most Americans learned about years ago is not the same rule that exists in 2026. And if you manage your money the way most people did in 1985, you may be triggering reporting requirements without knowing it. In the next 25 minutes, I will walk you through exactly what has changed, how it affects everyday retirees, and 5 specific steps you can take this week to make sure your money moves smoothly when you need it to. Before I get to the 5 changes, I want to share a real situation that illustrates how these rules affect people who have done nothing wrong. Martin is 71. Carol is 68. They live outside Phoenix, Arizona. Martin spent 39 years as a regional manager for a paper distribution company. Carol was a registered nurse for 3 decades. Last October, they decided to purchase a replacement car for Carol with cash to avoid financing charges. The price came to $40,600. Martin went to his bank the following morning to withdraw the funds. After handing the teller his withdrawal slip, he was asked to step into a private office with a branch manager. The manager asked why he needed that amount in cash, whether anyone had instructed him to make the withdrawal, and whether he had been contacted by anyone new online. Martin, a mentally sharp 71-year-old with no cognitive impairment, was being asked to explain a straightforward purchase to his own bank. When he clarified the situation, he was told the withdrawal would be delayed by 72 hours. He had to return to the dealership and ask them to hold the vehicle. When Martin finally completed the purchase, he believed the matter was closed. It was not. Within 30 days, he received a letter informing him that a suspicious activity report had been filed with the Financial Crimes Enforcement Network. That report now sits in a federal database for 5 years, linked to every future transaction Martin and Carol make. Martin is a retired paper salesman who bought his wife a car. His experience is not unusual. To understand why situations like this are becoming more common, you need to understand the number that has not changed in over 50 years. The $10,000 reporting threshold was written into the Bank Secrecy Act of 1970. In that year, a gallon of gas cost 36 cents. The median home price was $23,000. $10,000 represented more than most Americans earned in a full year. Adjusted for inflation, that same threshold would be approximately $81,000 today. Congress has indexed Social Security benefits and income tax brackets for inflation over the decades, but the Bank Secrecy Act threshold has never been adjusted, not once. Meanwhile, the ordinary financial transactions of a retiree, a car purchase, A medical bill not covered by insurance, a kitchen renovation, a pension rollover now routinely exceed $10,000. The same threshold that was designed to identify serious financial crime in 1970 now flags the routine financial activity of ordinary retired Americans. That is the baseline. Now, here are the 5 specific changes. In 2024, the Financial Crimes Enforcement Network issued updated guidance to banks on detecting and preventing elder financial exploitation. That guidance, combined with updated regulation best interest rules from the Securities and Exchange Commission, gave banks both the authority and, in many cases, the obligation to delay withdrawals from senior customer accounts for up to 72 hours when their compliance systems identify what they classify as a reasonable suspicion of potential exploitation. What counts as reasonable suspicion in a bank's compliance software is not necessarily what you would expect. It is not a suspicious phone call or a fraudulent email. It is a withdrawal that deviates significantly from your established transaction history. If you have spent several years withdrawing a few $100s per week and you walk in requesting $10,000, the software flags that change in pattern. It does not evaluate the reason. It flags the deviation and initiates a review. That review can hold your funds for up to 72 hours, regardless of what you need the money for. More than 37 states have passed their own senior safe banking laws that provide banks with legal immunity when they delay transactions they suspect may involve elder exploitation. That immunity eliminates the legal risk for the bank of delaying your funds while creating no penalty for the bank if the delay turns out to be unnecessary. The financial incentive points in one direction. A bank that delays your withdrawal incorrectly faces no legal consequence. A bank that releases funds to an actual fraudster faces liability. And critically, if your bank delays your withdrawal under this guidance, they are not legally required to tell you that is the reason. They can describe it as a processing review, a compliance check, or give no specific explanation at all. You do not have a legal right to immediate access to your funds during that window. Under Title 31, United States Code, Section 5324, it is a federal felony to divide deposits or withdrawals into smaller amounts for the purpose of staying below the $10,000 reporting threshold. The maximum penalty is 5 years in federal prison, forfeiture of the funds, and fines of up to $250,000. The important detail here is that the funds do not need to be connected to any other illegal activity. If the government can demonstrate that the transaction pattern was intentional and designed to avoid the reporting requirement, the structuring charge stands on its own. The money can be entirely legitimate, proceeds from a home sale, a pension distribution, an insurance settlement. The pattern itself is what matters. For many years, enforcement focused on deposits in the $9,000 to $9,900 range, where intent was relatively straightforward to establish. In 2024, the pattern detection software used by banks was significantly upgraded. The threshold at which these systems now flag accounts for potential structuring has dropped. Regular deposits of $7,000 or $8,500 spaced in a way that could be interpreted as intentional can now generate a flag. That flag can produce a suspicious activity report, which can lead to a referral to the IRS Criminal Investigation Division, which can lead to a civil asset forfeiture action. The Institute for Justice, a public interest law firm, has documented multiple cases of American citizens whose bank accounts were seized under structuring rules without a criminal charge ever being filed. A family grocery operation on Long Island had $446,000 seized because the owners made regular deposits under $10,000 to remain within their on-premises insurance coverage limit. A completely legitimate reason. A dairy farmer in Maryland and a convenience store operator in Iowa lost significant funds through the same civil forfeiture process. None were ever convicted of a crime. Civil forfeiture does not require a criminal conviction. Once your funds are seized, you must demonstrate your innocence to recover them. The legal separation between traditional banking and peer-to-peer digital transactions no longer exists in the same way. Beginning in tax year 2025, all major U.S. cryptocurrency exchanges are required to file Form 1099-DA, which reports every customer transaction directly to the IRS. Any single crypto transaction of $10,000 or more now falls under the same Bank Secrecy Act reporting requirements that apply to cash. At the same time, reporting thresholds for Zelle, Venmo, Cash App, and PayPal have been steadily reduced. In 2023, the threshold was $20,000. In 2024, it dropped to $5,000. In 2025, it dropped to $2,500. In 2026, it is scheduled to reach $600. That means a $600 Zelle reimbursement from a church event, a $700 Venmo payment from a neighbor for something you sold, or $800 from a grandchild through Cash App for a birthday dinner now falls within the reporting window. A $12,000 Zelle transfer to a child for a down payment enters the same FinCEN database as a $12,000 cash transaction at a bank. Same report, same database, same 5-year retention. Form 8300 is the report any business must file with the IRS when they receive more than $10,000 in cash, cashier's checks, or money orders from a single customer in a single transaction or in related transactions. This applies to car dealers, attorneys, contractors, jewelers, real estate professionals, and under recent guidance, crypto businesses and digital payment platforms. Electronic filing is now mandatory for most businesses, subject to this requirement. The per filing penalty for late or incorrect submissions was increased to $290 per return. The penalty for intentional disregard was increased to $3,140 per return. Those penalties fall on the business receiving payment from you, which creates a strong incentive for every business you pay to file accurately and on time. When you pay a contractor $12,000 for a roof, they file Form 8300 identifying you by name, social security number, address, and transaction type. The same applies to an attorney retainer, a vehicle purchase, or a significant home improvement project. That filing goes to the IRS and enters the same database tracking your bank transactions. One detail worth noting: related transactions are aggregated. If you pay a contractor $6,000 this week and $6,000 next week for the same project, those payments are treated as a single $12,000 transaction, and the contractor is still required to file. Splitting a payment into smaller amounts to avoid triggering the form can create a structuring issue, even when the payment is for a legitimate service. This is the context that ties the other 4 changes together. Over 55 years, the ordinary annual finances of a retired American have grown substantially in dollar terms, while the $10,000 threshold has remained fixed. A routine year for a retiree might include a vehicle purchase, a home repair, a medical expense not fully covered by insurance, a lump sum pension distribution, the proceeds from a property sale, maturing savings bonds, or a significant gift to a family member. Each of these now routinely exceeds $10,000. That means routine financial activity now triggers reporting, review, and documentation requirements that were originally designed for a very different set of transactions. The average retiree may be crossing federal reporting thresholds 3, 4, or 5 times per year without being aware of it. Those are the 5 changes. Here's what you can do about them. Before any withdrawal, deposit, or transfer of $8,000 or more, contact your branch manager directly. Explain what the transaction is for and ask them to note it in your customer file. When the transaction processes through the compliance system, that note is visible. The 72-hour delay is significantly less likely when you have pre-notified. A report will still be filed automatically for transactions over $10,000, but your access to your funds is not delayed. If you need to move $12,000, do not break it into 2 $6,000 transactions thinking you are simplifying the process. Move it as a single transaction, which triggers a routine report you will never directly encounter. If you are making multiple payments for a genuine reason, such as installment payments on a service contract, make sure there is clear documentation of the business purpose. The pattern detection software cannot read your intent. Your documentation can. The Bank Secrecy Act reporting framework was built around physical cash. Wire transfers operate through a different system with different thresholds and fewer false positive flags on senior accounts. If you are moving a significant amount to a car dealer, contractor, or attorney, ask whether a wire transfer is acceptable. Many businesses prefer it because it eliminates their cash handling and Form 8300 filing obligations. If you use a single Venmo or Zelle account for family reimbursements and also for occasional income from selling personal items, the combined total may cross the $600 reporting threshold and generate a Form 1099-K. Maintaining separate accounts for personal activity and any quasi-business activity makes your records cleaner and prevents the wrong totals from appearing on tax documents. For every transaction over $5,000, record the date, amount, source of funds, recipient, and purpose. A simple notebook is sufficient. A spreadsheet is more practical. Most civil forfeiture and structuring cases that affected innocent account holders turned on whether the individual could produce documentation explaining why their transaction pattern looked the way it did. Clear records establish a legitimate business purpose. Without them, you are relying on a federal reviewer to accept your explanation without evidence. Before I close, I want to mention one additional step that Senior Tips USA has covered in more detail on this channel. Most major banks offer a process, sometimes called a senior banking authorization or trusted contact designation, that allows you to pre-document your typical large transaction categories and identify a contact person the bank can reach before placing a hold on your account. This process is not widely advertised, but most banks will walk you through it if you ask to speak with their senior customer services department or wealth management group. Once it is in place, transactions that match your pre-authorized categories are much less likely to trigger the 72-hour review process. Martin and Carol put this in place after their experience last year. They have made 4 additional large transactions in the past 12 months without a single delay. For those who want everything covered in this video compiled into a single reference, our team at Senior Tips USA has put together the 2026 Retiree Banking Protection Checklist. It covers the 5 rule changes from this video, commonly missed retiree deductions, estate planning considerations, Social Security and Medicare timing decisions, and step-by-step instructions for setting up the senior banking authorization at the major U.S. banks. You can find it at marcusgraves.com. If you plan to file your own taxes this year, I recommend taking a look at TaxSlayer. It handles every situation a retiree typically faces: Social Security income, pension distributions, required minimum distributions, capital gains, and the new 1099-K reporting requirements. And it costs less than the major competitors most people default to. There is a link in the description below, and using that link supports this channel at no additional cost to you. The $10,000 threshold is not going to be adjusted for inflation in the near term. The reporting system is not becoming simpler. The most practical thing you can do is understand how the current rules work and manage your transactions accordingly. Pre-notify your bank. Document your purposes. Move large amounts by wire when possible. Keep your digital payment accounts organized, and put the senior banking authorization in place before you need it. At Senior Tips USA, we will keep covering these topics as the rules continue to evolve. Next week, I will be looking at which banks have the most clearly structured senior protection programs and which institutions have been the slowest to implement clear communication policies for senior customers. If someone you know, a parent, sibling, neighbor, or friend, is managing significant money and has not heard about these changes, sharing this video is a straightforward way to make sure they have the information before they need it.